Good afternoon. My name is Josh White, and I'm a shareholder in the financial services practice of Elliott Davis. On behalf of all of our team members here at Elliott Davis, let me first say that we hope you and your families are safe and healthy during this uncertain time. It's my pleasure to kick off our webinar as we began discussing a multitude of issues with our banking clients over the past 3 to 4 weeks related to COVID-19. We thought it'd be helpful to try to discuss some of the most talked about items with you, our clients, prospects, friends, just to help you as you try to close out your quarter. So earlier today, you should have received an email from our financial services email address with copies of the slide deck for today's webinar. In case you did not receive those and you would like a copy, please send me an email. My email address is josh.white@elliottdavis.com. It's also in the back of the presenter materials, and I will send those over to you today or tomorrow so you can use those as a point of reference. Also, would just note we're expecting to hit our capacity for the maximum number of people in this webinar based on our registrations. So if you have trouble logging in, or if you've heard from a peer that they've had trouble logging in, we do plan to record this, and we will try to post it or disseminate it from our website or via email in the coming days. Also, as a disclaimer, all of the Elliott Davis presenters are working from home today, so we're using home Wi-Fi, cell phones, things of that nature. So in case we run into any technical difficulties, which may include delays in slides, spotty phone service, and or the sounds of kids or pets in the background, just bear with us as we try to get those ironed out during the course of this, during the course of the presentation. So just a few housekeeping items for us. We have all phone lines muted to participants to reduce or eliminate background noise. Therefore, if you have any questions throughout the webinar, please submit them via the chat function. We've allocated a few minutes at the end of the webinar to answer questions. Any questions we do not get a chance to address, we'll plan to respond back within a day or so to the question answer or asker. But also we'll be compiling if there's any frequently asked questions, and we'll try to disseminate those to the larger group if we find a frequent question that folks are looking for common answers to. So let me get to today's presenters. So we'll have helping us, in addition to myself, we'll have Christy Griffin, Mark Scriven, and Marshall Troll, who are all senior managers within our financial services practice at Elliott Davis, as well as Livingston Moyd, Livingston's a director with the firm's valuation group, who will be helping us in our discussion about goodwill. So when looking at our agenda, as you're aware, with COVID-19 is having a pervasive impact on not just us and our institutions, but the U.S. and global economy. So our goal in trying to find items to discuss with you all today, we tried to look at some of the key accounting and financial reporting issues that we feel like are being most impacted and we're having the most conversations about. Those tended to relate to the allowance for loan loss, specifically how to consider the impact of COVID-19, whether it be the allowance or the CECL model. Goodwill, and specifically goodwill impairment, troubled debt restructurings, and also loan fees related to the Paycheck Protection Program. So with that, I'll turn it over to our first presenter, Christy Griffin, who's going to cover the allowance for loan losses.
Thanks, Josh. So COVID-19 presents a unique challenge to estimating the allowance for loan losses for the first quarter of 2020. But because there are still more questions out there than answers about the impact of the outbreak on the global economy. Our hope today is to give you some insights and just some things to consider as you're preparing your allowance this quarter. So we have received a significant number of questions on how COVID-19 could affect the allowance in either under CECL or the incurred loss model. So this part of the webcast, we're going to focus on the qualitative and environmental factors within the allowance model. And the QE factors under CECL are largely the same under the incurred loss model. So the items discussed today are relevant for both models. We want to acknowledge that each day the COVID-19 pandemic evolves and changes, which makes estimating the allowance this quarter extremely difficult. However, it is important to be proactive and intentional in identifying the risks specific to your loan portfolio. So today we want to answer two questions. When should the COVID-19 pandemic be addressing the allowance, and how will the allowance be impacted? So we first want to make it clear that we believe the COVID-19 pandemic is a Q1 2020 issue. It'll be a Q2 2020 issue as well, but we should be addressing this issue in the 3/31/2020 allowance calculation, and it should be evaluated in light of the current environment. So then the next question would be, how do we anticipate these changes to occur? So your qualitative and environmental factors should be capturing credit losses that are not captured in your historical losses. Based on the timing of COVID-19 pandemic, your current historical losses have yet to be impacted and are probably still at all-time lows. So therefore, it's very important to evaluate and adjust the QE factors to capture anticipated credit losses in your institution's portfolio. The next few slides include the qualitative and environmental factors outlined in the interagency guidance in SAB 102 incurred loss model and SAB 119 for CECL. And we've added some items to consider related to each factor in light of COVID-19. I'm going to focus on the factors that we consider to have the biggest potential impact related to COVID-19. But please read through the slides and let us know if you have any questions on any of the items included. Just as a reminder that you need to consider your institution's facts and circumstances and how COVID-19 impacts the credit quality of your loan portfolio specifically. So we're first going to look at the changes in the economy and business conditions, because this factor is likely to have the biggest impact on the allowance. It's been a big change. The world we live in today is very different than where we were a month ago. The economic outlook is significantly different than where we were at 12/31/19. So your QE factors should be adjusted to reflect this change. I'm going to throw a couple of stats there out at you just to make it very clear of kind of the change that has occurred. So unemployment was up to 4.4% at the end of March 2020. And I think in mid-February, we were at a half-century low. So 4.4% isn't a drastic increase, but that was just the beginning. When I prepared these slides a few days ago, the projections were showing an estimated unemployment rate of 10% in April and possibly 15% by summer. Well, new information came out this morning that showed that in the past 3 weeks, 1 out of 10 workers have lost their jobs. And that the estimation for April's unemployment actually went up to 15%. So again, things are changing rapidly, and we really need to be acknowledging these. A few more things that I wanted to point out was non-grocery retail sales are down 97% in the last week of March. Airlines have plunged 97% compared to the same period last year, and hotels revenue has dropped 80%. So those are just a couple of key industries that have been impacted. And so it's very critical that you're looking at your portfolio and the makeup of the loans in your portfolio to determine how the economy changing is going to impact you. So even though the economy looks really different, it's likely that your institution's non-accrual and past due loan levels have yet to be significantly impacted, as these tend to be lagging indicators. But it's still important to look at changes and anticipated changes in your credit quality metrics at a loan pool level and at industry-specific levels. We know, we've been talking to you guys, that you have borrowers coming in every single day requesting deferrals, payments, interest-only payments, and all kinds of modifications due to the COVID-19 pandemic. So we suggest that these COVID-19 modifications be tracked, quantified, and scrutinized in a granular level, as this will give insight on potential credit issues. The COVID-19 modifications data can be used to identify the risk in your portfolio and will be a leading indicator of the credit issues to come. I also want to make a quick note on risk grading. So it's important that your risk grades are accurate and changes in grades are made timely. Resist the temptation to defer recognizing a potential downgrade for another quarter to see if results improve. You cannot monitor what you do not identify, and it's critical in a time like this to have a full inventory of potential problem loans, even if you believe they'll be short-term in nature. A lot of lessons were learned from the 2008 recession, and one of those lessons were that banks that were timely in risk identification generally had a much higher level of success than the peers that lacked in identification. So as downgrades occur, as we expect them to, the increase in your classified loans should be considered when adjusting your QE factors. It's likely too soon to make significant adjustments related to changes in underlying collateral, but this should be closely monitored. For the higher risk industries such as hospitality, entertainment, retail, dental, the level of collateral protection should be monitored closely, and your systems should be evaluated to see if they're effective in monitoring the collateral. Account for the fact that your CRE borrowers have collateral values that are directly related to cash flow. And as cash flows fall, so will the underlying collateral values. You cannot rely strictly on your existing appraisals, as circumstances have changed since those appraisals were obtained. If you're relying on receivables and inventory or construction and process for collateral protection, it is imperative that you are monitoring these assets and monitoring the advancement of funds to ensure that's appropriate. When evaluating the QE factor related to concentrations, we encourage you to review your commercial concentrations and be as granular as possible in your assessment. While some industries may experience minimal effects from the current crisis, most will experience some issues, especially those in consumer-based services such as hotels and restaurants. Consider the potential impacts on each industry and rank the industries by risk. It is important to make a realistic assessment of how much your portfolio will be significantly affected by COVID-19, because this should flow into your analysis of your allowance for loan losses. And when you do this assessment, the total potential impact could be large. So it's important to fine-tune this estimate and evaluate individual borrowers. It would be prudent to determine which businesses are shut down based on various government regulations. You also should be requesting updated financial information from your high-risk borrowers. You should be discussing capital plans and liquidity plans. Do your borrowers have access to credit, lines of credit? Is there personal liquidity available? Are they applying for SBA assistance? All of this information can help you decide which borrowers may be able to work through this and which ones will need additional assistance and attention. If you have the resources, you should consider stress testing the effects of sales decline on cash flows and liquidities. We know that companies with limiting working capital going into the crisis are going to have a difficult time. And then one note on the regulatory environment. It would appear that the CARES Act and regulatory guidance passed in response to COVID-19 would be seen as favorable for banks. However, it is important to realize that a loosening of regulation rules may lead to greater risk, which in turn increases the potential for credit losses. It seems like new guidance is released each day, and the regulatory environment is no different than the world we're living right now. It is volatile and unpredictable. We want to make sure that you consider how changes in the regulatory environment could affect credit quality. And one last note, as any good auditor can't pass up an opportunity to mention documentation. All I'm going to say is that adjustments you make or lack of adjustments you make to your QE factors should be supported and adequately documented. All right, now I'm going to turn it over to Mark and Livingston to discuss goodwill.
Thanks, Christy, and good afternoon, everyone. In light of COVID-19 and the significant impact that it's had within our economy, we wanted to touch on the impact as it pertains to goodwill and whether or not impairment has occurred. Now, I'll focus on the concepts more from an audit perspective, while Livingston will focus on some of the more nuanced valuation considerations. We may have some overlap in our material, but hopefully we can help provide some perspective and help you think through the challenges of whether or not goodwill has been impaired. As we all know, goodwill is tested for impairment on an annual basis. However, goodwill must also be evaluated for impairment between annual tests if a potential triggering event or impairment indicator has occurred or been identified. Unfortunately, the economic fallout from the coronavirus likely represents a triggering event. Now, turning with me to the next slide, we've included a number of potential triggering events and other factors to consider when evaluating whether impairment has occurred. Again, from our perspective, the current economic environment and the market cap decreases that have occurred likely means that companies should perform an interim quantitative evaluation for impairment. However, companies should also consider the severity and duration of such decline as part of their analysis. Another way to think about it, a short-term decline in stock price or market cap may not truly be indicative of significant changes to your business or your projected cash flows. At the end of the day, companies should also consider their own specific facts and circumstances. As an example, if stock price is 95% a book, that's obviously significantly better than a company with stock price at 60% a book. Another consideration would be to revisit your most recent impairment evaluation and consider the existing headroom. In other words, what was the excess of fair value over your carrying amount? Again, have the recent changes impacted your projected cash flows? Have you had to modify a significant portion of your loan portfolio, or have projected cash flows remained fairly stable over the last few weeks? If so, it's certainly a mitigating factor to consider. Now, turning to the next slide, GAAP states that the evaluation of fair value should be performed as of the test date and does not include a concept of whether or not the decline in fair value is temporary. However, due to the significant volatility in stock price, we do think that companies can and should incorporate some aspect of reasonableness as it pertains to the impairment evaluation in determining the true fair value of the company. Maybe this includes evaluating stock price by incorporating a recent range of dates or evaluating how quickly the decrease rebounded. But we do strongly encourage companies to think through all factors, both positive and negative, and ultimately to discuss with their audit team and or their third-party valuation specialist as soon as possible. Now, moving with me to the next slide, in January 2017, the FASB issued ASU 2017-04, which ultimately simplifies the quantitative impairment test. Similar to most new standards, ASU 2017-04 has staggered effective dates. However, early adoption is permitted. And because of that, a lot of companies adopted the new standard once it was issued. However, if you haven't, again, the new standard does certainly provide an opportunity to simplify the impairment calculation. One item to note, though, technically the previous methodology did incorporate a measurement period concept whereby companies could identify impairment, in other words, fail the legacy step one, and then measure the amount of impairment over the course of the next quarter. This was mainly because the previous step two was so much more complex and time and labor intensive. And unfortunately, my understanding is that this measurement period concept no longer exists under 2017-04 due to the simplified nature of the calculation. Now, turning to the next slide, we've included a graphic that illustrates the changes in the impairment test process prior to and after adoption of ASU 2017-04. As you can see, the old methodology had an extra step whereby companies had to determine the implied fair value of goodwill and then evaluate the amount by which implied fair value of goodwill was less than carrying value. The new standard simplifies the quantitative test in that it removes the requirement to determine implied fair value of goodwill, and impairment is simply just calculated as the amount by which fair value of your reporting unit is less than its carrying amount. I did also just want to remind everyone that depending on your calculations, the fair value of your reporting unit could be significantly less than the carrying amount, again, just with the severe decline in stock price. But ultimately, the impairment charge will be limited to the amount of goodwill on the books. In other words, you can't have a write-off that exceeds the value of the goodwill, even if the fair value of your reporting unit is significantly less than carrying value. Now, turning to the next slide, the quantitative impairment test will ultimately be conducted in accordance with ASC 820, which is the fair value guidance. And ASC 820 outlines three valuation approaches: market, cost, and income. Now, I think Livingston will walk you through the methodologies in a little more detail shortly, but it's important to think through which approach is most appropriate for your reporting unit and whether there's adequate data to use the identified approach. I also just wanted to mention that it is common for companies to utilize multiple methodologies such as discounted cash flows and market multiples within their analysis. Now, turning to my last slide before I turn it over to Livingston, and I'm mainly just going to focus on the last main bullet on this page. So as we've discussed, there's obviously a lot of noise in the market right now. Recent stock prices and market cap for many of you likely indicate a potential impairment indicator or triggering event. I wanted to mention the SEC has indicated that evaluating an interim triggering event is not necessarily a specific point in time like GAAP kind of calls out. However, the SEC has also indicated that companies are not supposed to ignore a significant decline in market capitalization. So to summarize these past few slides, and as I mentioned previously, think holistically about both positive and negative factors and the impact to your company. Again, how much recent headroom was identified from your most recent quantitative analysis? What is the impact to projected cash flows for this quarter, for next quarter, for this year? How much of your loan portfolio has been modified? Are there other financial or operational factors to consider? Livingston will likely touch on the control premium concept as well, but consider looking at control premiums from 2009 to 2010, which was our most recent truly distressed market. I believe those control premiums were higher than our more recent market transactions. Again, just some items to be thinking about as you're evaluating your Q1 and Q2 activity and whether or not your goodwill needs to be impaired. With that, I'll turn it over to Livingston.
Thanks, Mark. Appreciate it. So I thought it'd be good to kind of walk through the different valuation methods, kind of referencing back to Mark's previous slide on what they are. So I took the time to break out the different methods, specifically on the market income approaches. I lead our head financial reporting practice for the firm in terms of valuation. And so these are the methods that we typically see both when we're valuing financial institutions as well as performing audit reviews for our audit team. So if we think about the methods under the market approach, I've listed 3 here. The precedent transaction method, while it's the third bullet, is really looking at transactions that have actually occurred in your specific financial institution's equity. So that could be, the stock price that's traded either over the counter or on some major exchange. Or if you're private, it could be some sort of transaction that has occurred within a reasonable period of time. So that's, obviously the best thing to look at since it's specific to the financial institution itself. However, something to think about there is when did the transaction occur relative to the test date? And was this a controlling transaction? Because the premise for goodwill impairment testing is a hypothetical controlling transaction of the reporting unit. So we need to keep that in mind when we're determining which valuation methods to use when we do some sort of step 1 quantitative test. For the guideline public company method, this would take banks that are believed to be comparable to your specific financial institution and take a look at, based on their market cap, what their implied multiples are, whether that be a multiple of book value, tangible book, assets, net income, core earnings, any of those metrics. One thing to keep in mind, and I'll allude to this earlier, is the guideline public company method, because it relies on shares of stock that's publicly traded on a per share basis, we'll also need to consider control premiums associated with that under this hypothetical control transaction lens that we need to look at the goodwill impairment testing through. The final one on the market approach, the guideline transaction method, takes a look at banks or financial institutions, both private and public, and takes a look at what the price paid for those was and implies multiples based on their most recent financial metric. Another thing to keep in mind here is that these transactions most likely close in a different economic environment relative to the one we have today. So I would very much caution you, if you are going to take a look at guideline transactions, make sure you do have a good case about are they appropriate to use based on the current environment. The other method to use here, the income approach, this is going to be, if you're not publicly traded, this is going to be the most specific to the reporting unit because it is a projection of earnings or cash flows specifically based on the assets and liabilities that are on the balance sheet as of the test date. So this is going to be the most specific, but it's also going to be the most subjective because it involves some sort of projection of cash flows and ascribing an appropriate level of risk associated with those cash flows. Now, again, keep in mind here that the assumption of a hypothetical controlled transaction of the reporting unit, when you're looking at operating expenses or some sort of revenue projection, think about it from a market participant synergy perception too, of what could be some cost savings potentially if a market participant came in and acquired this reporting unit, or if there's a level of investment needed that could produce higher cash flows. As long as they're in line with market participant assumptions, it's definitely something to consider when using these methods. On the next slide, you'll see that the guidance, both ASC 350 as well as a lot of the Big Four guidance that kind of elaborates on that, talks about a reconciliation to market cap. And when I talk about a reconciliation to market cap, I'm specifically talking about financial institutions who are publicly traded with sufficient volume. So you could be traded over the counter or on another exchange that may not have certain trading or volume requirements for shares. It may not be as applicable, this reconciliation to market cap, because there's not sufficient volume there. And so those transactions could be skewed by certain facts and circumstances. And so that's just something to keep in mind. But as it mentions in the first bullet, you'll see it's not required by US GAAP. And this is in the context of reconciling all the reporting units that comprise a company or a bank or financial institution, reconciling all those fair values to the aggregate market cap of that financial institution. So it may be most applicable if you have maybe one or two reporting units. The more reporting units it has, the more room there is to manipulate certain reporting units versus other reporting units to ultimately get back to market cap. So it's really most meaningful when you have, 1 to 3 reporting units. And also it's not required by US GAAP, but it is considered a best practice. On the next slide, just continuation of the market cap discussion. Going back to what Mark talked about the stock price as being not being a point in time estimate, but being as a reasonable period of time leading up to the impairment test date. Also not ignoring any trends. So if you think about 3/31/20, you're looking at that test date and saying, okay, your stock's trading at $20 a share. But if you look at it over the past 3 weeks, then it's trended from 30 to 20. So that decline can't be ignored, and it should definitely be considered in what you ultimately do select for the price per share. One other thing to think about, if you go to the next slide, would be the control premium associated with the markup on the per share value here. So the guidance from the Appraisal Foundation, which is a member of several different public accounting firms, came together and wrote a best practice on control premiums. It's entitled Market Participant Acquisition Premiums, and it's available online through the Appraisal Foundation's website. But when it comes to talking about what goes into a control premium, it's really the ability, it's defined as the power to direct management decisions or policies of a business. And so a control premium is typically paid when there's some sort of enhanced cash flow expectations from another buyer coming in. Maybe they can make certain investments that will cause revenue to go quicker. They can realize certain cost savings through the reduction of redundant positions or branches or other expenses, or through a lower cost of capital. So those are really the two main drivers of the control premium. Really what we need to do is think about, what would we change? How's the business currently running? What would we change? And how much incremental benefit can we have on the cash flows or the risk profile of the company? And what would we be willing to pay over and above the per share value of the company? The next slide is just going to go back through and talk about the Appraisal Foundation guidance. I have it available if anybody wants it. But I'll kick it back over to Mark to wrap up the goodwill impairment section.
Thank you, sir. So to close us out here, a couple of bullet points for your reference as you're preparing your financial statement disclosures. First, did you have impairment? If so, disclose how much and what the facts and circumstances were that led to the impairment. Second kind of key item is, what are the company's impairment testing policies? How are reporting units identified and aggregated? Ultimately, how was fair value determined, and what were the significant assumptions that were utilized in your analysis? And last, did you have any reporting units where fair value did not substantially exceed carrying value? If so, you're expected to disclose what reporting units may be at risk of failing a future quantitative test. So be mindful of that as well. And with that, I'll turn it over to Marshall with TDRs.
Okay, thanks, Mark. So I'm going to go through the latest on modifications and the potential for troubled debt restructurings in relation to COVID-19. I'll start with the caveat that this, like everything else, is evolving and constantly changing on a daily basis. But starting last Tuesday, April 7th, recent interagency guidance was issued, an interagency statement titled Loan Modifications and Reporting for Financial Institutions Working with Customers Affected by the Coronavirus, revised. So this was a revised statement that provided some clarification between the previously issued March 22nd interagency statement with the same title and Section 4013 of the CARES Act, which was signed by the President on March 27th. It's important to note that this guidance does not revise GAAP, but it does provide financial institutions the option to temporarily suspend GAAP related to TDRs for a limited period of time due to the effects of COVID-19. So on the next slide, the revised interagency guidance clarified that under the CARES Act, an eligible loan modification can be accounted for under Section 4013 of the CARES Act or under GAAP ASC subtopic 31040. For a loan modification to be eligible under Section 4013, it must meet all of the following criteria. Number one, the modification has to be in relation to COVID-19. Number two, the modified loan could not have been more than 30 days past due as of December 31st, 2019. And finally, the modification is executed for the applicable period, which is defined as between March 1st, 2020 and the earlier of 60 days after the date of termination of the national emergency or December 31st, 2020. So whichever of these two dates is earlier. So on the next slide, if this previous analysis that I discussed for the three steps is completed and it's determined that the loan modification meets the Section 4013 guidelines under the CARES Act, then the following is true. No further TDR analysis is required, and the modification should not be reported as a TDR within regulatory reports. The loan is not considered impaired, and there is no need to determine impairment utilizing methods that would have been required for TDRs under ASC 310-10. And then finally, there is no requirement to apply ASC 310-40 for the term of the loan modification. Now, if the loan modification does not meet the guidelines discussed within Section 4013 of the CARES Act, then ASC 310-40 will apply. And I'll go through a quick refresher on that on the next slide here. So what is the GAAP definition of a troubled debt restructuring or a TDR? Within GAAP, a TDR is defined as occurring when a creditor, for economic or legal reasons related to a debtor's financial difficulty, grants the debtor a more than insignificant concession that it would not otherwise consider. Based on that, the process to determine whether a loan modification constitutes a TDR is a two-step process. First, you must determine if the borrower is experiencing financial difficulty, i.e., is the borrower actually troubled? Number two, is the institution granting a concession, i.e., are modified terms that are more attractive than standard market terms being offered? The key being that this concession is more than insignificant as defined above. Just a reminder here that even under GAAP, disregarding COVID-19, modifications of loan terms do not necessarily automatically result in TDRs. So it is absolutely possible to have a modification where a borrower is experiencing financial difficulty, a concession is granted and not have that result in a TDR due to the insignificance threshold under ASC 310-40. So next slide, what does the interagency guidance say regarding these COVID-19 related modifications? First, and very importantly, the regulators did confirm with the staff of the FASB that short-term modifications that are made on a good faith basis in response to COVID-19 to borrowers who were current prior to any relief are not TDRs. This includes short-term, such as 6-month modifications, payment deferrals, fee waivers, extension of repayment terms, and other delays in payment that are considered insignificant. This interagency guidance also states that borrowers are considered current if they are less than 30 days past due on their contractual payments at the time a modification program is implemented. I do want to acknowledge here that the concept of when borrowers are considered current in this scenario does differ from the current definition in the CARES Act. So due to this ambiguity that currently exists, it's going to be more important than ever to develop some policies and procedures surrounding these COVID-19 modifications. As Christy mentioned earlier, if possible, it is a very good idea to track these modifications separately within your core system, possibly utilizing a loan flag or some other method to do so. So, in summary, for loan modifications designed to provide temporary relief for current borrowers affected by COVID-19, a financial institution may presume that borrowers that are current on payments are not experiencing financial difficulties at the time of modification for purposes of determining TDR status. Therefore, that modification would not pass the first step in the TDR determination process, where you would determine if the borrower is experiencing financial difficulty, and therefore no further TDR analysis would be required for the modification. Also of note within the recent interagency guidance is that modification or deferral programs that are mandated by the federal or a state government related to COVID-19 are not within the scope of ASC 310-40. So this would be a state program that could require all institutions within that state to suspend mortgage payments for a specified period. Okay, so all of that considered, for determination of the TDR status of the modification, one of the key logistical considerations related to the modification itself is how interest is going to be accounted for. The first key consideration is determining whether interest will continue to accrue during the deferral period as part of the specific modification or modification program. If the modification is structured to where interest will not accrue, then you have two options that were addressed by the April 8th, so yesterday's call by for the FASB board meeting. The first option is that you can choose to recognize interest income during the deferral period by utilizing a new effective interest rate under ASC 310-20 that equates the revised remaining cash flows to the carrying amount of the original debt and is then applied prospectively for the remaining term of the loan. What this in effect does is functions to lower the yield on the loan over its life, and interest income would still be recognized during the deferral period. The second option here is you choose not to recognize interest income due to the revised contractual terms of the modification. Both of these options were deemed acceptable by the FASB during yesterday's meeting. So on the next slide, if the modification or program is structured so that interest will continue to accrue during the deferral period, then the question becomes, how will the balance of interest after the deferral period be treated? I've listed a couple of options below here, but these options are by no means comprehensive as to what could happen to that accrued interest. The first being that you could postpone the interest until later in the life of the loan, which would typically result in a balloon payment at maturity. Choosing this method could result in reserve being required depending on a determination of the likelihood of receiving that payment. Second option being that you could capitalize the interest, thereby adding it to principal, and then re-amortize the loan once payments resume. A word of caution here, however, that capitalizing the interest will increase monthly payments moving forward and could also result in negative amortization during the deferral period. This negative amortization could potentially then have additional regulatory compliance, especially for consumer real estate lending and other accounting complications. So here I've just listed a couple other items that were included within the interagency guidance that I thought would be helpful to note. The first is regulatory capital relief, which states the efforts to work with borrowers of 1 to 4 family residential mortgages where the loans are prudently underwritten, they're not past due or carried in non-accrual status will not result in the loans be considered restructured or modified for the purposes of their respective risk-based capital rules. The second piece is that there is no expectation based on this guidance to designate loans with deferrals related to COVID-19 as past due. And on a general basis, loans should not be classified as non-accrual assets during these short-term arrangements. So I'll end with a couple reminders related to consumer protection and regulatory compliance considerations related to loan modifications in COVID-19. It's been stated that in regards to future examinations that an institution's good faith effort will be taken into account regarding modifications as a result of COVID. However, there are some areas to be aware of moving into these modification scenarios. The first being fair lending. The key here is that clear guidance needs to be provided on approval and eligibility criteria for modification programs. As much as possible, it would be advisable to limit one-off scenarios related to modifications. And the modification process should be as centralized as possible. For the Flood Disaster Protection Act, the concern is the terms of the modification could trip the make, increase, renew, or extend requirements under the Flood Act, which could then trigger the requirement to obtain a new flood hazard determination, along with other implications related to flood insurance. RESPA mortgage servicing would also come into play regarding loss mitigation procedures. And this could also come back into a fair lending implication if borrowers are not treated equitably during the mortgage servicing and loss mitigation process. If you're modifying consumer real estate loans that have escrow accounts, the question would be if the payments on the escrow account are going to continue during the deferral period. This could be a substantial portion of a borrower's monthly payment. And then how is this deficiency, imbalance, and future increased payment going to be disclosed to the borrower if those escrow payments will not continue during the deferral period? Finally, not listed here, but just a reminder that there are also implications within the CARE Act related to other compliance areas such as fair credit reporting. If relief such as a payment deferral, forbearance, et cetera, is provided, you are required to report the account as current or up to date. So that's all I have related to loan modifications, and I'll pass it off to Josh.
Thanks, Marshall. Much appreciated. And kind of one general comment I have, I guess, looking into my crystal ball about TDRs and allowance. I know we're all up to speed with our crystal ball now since we've been talking about CECL and we're forecasting experts. But at least a word of caution that I'm seeing, I'm thinking with substantial portions of your loan portfolio being modified, pushed out, I think there's going to be a lot of uncertainty over the next few months about what this looks like. My guess is that you might start from a credit quality issues. You might not start seeing really issues pop up until later in this year, even first quarter 2021. I know regulators have encouraged financial institutions to be working with their borrowers. And I think that is definitely the right thing to do, but definitely a word of caution to credit teams and some of the finance teams that we could potentially start seeing some blips pop up later in the year in early 2021. And from some of you that may have flashbacks to your days in 2008, 2009, 2010, you start getting also into subsequent event treatment, which was not a whole lot of fun to deal with for us as auditors, as well as clients and banks out there. So just something to put on your radar. Christy had some good information about diving into portfolios and making sure you're on top of kind of what your potential risks are, but just a thought with some of the items brought up. So the last item we'll be touching on SBA loan processing fees. I've probably had, I don't know, but for the last week and a half, probably at least 3 different phone calls a day related to this. And so we thought it would be helpful to touch on. I will say Marshall referenced FASB's meeting yesterday. FASB did acknowledge that they have gotten some commentary from this, and they do plan to provide some feedback and guidance on that with, I guess, quote unquote, their term, the coming days, when that'll be. I'm not sure. So right now, this is where we're trying to present what we believe at Elliott Davis, the proper way to look and assess these SBA loan processing fees from the PPP program, at least so you can get an idea of how you might want to handle. So most of the questions what we've gotten is, do we defer? Do we not defer? How do we go about deferring? What does that look like? And so I thought the easiest way to look back and the way we're viewing these are loan origination fees. And so what we did was we went back to the FASB Master Glossary and tried to look at the definitions, which you'll see on the screen here. And we believe these could there's 5 or 6 different criteria here. We have 2 of them on the screen. We really believe that the way these fees are structured, they really fall into, they would most likely meet the definition of fees for origination activities. And then also you could argue with the 1% rate on PPP loans that these also would really in substance be a yield adjustment related to loans that aren't getting picked up with the rate, and thus the incentive to make the loans could be via the fee. So we're viewing these, at least under our interpretation, is that these should be deferred over the life of a loan, similar to a FAS 91, what you traditionally do with FAS 91 fees. However, in light of that, I think there's some things that probably you need to think about as you're assessing these. First, I would stop and just assess, is the fee going to be material? From a time and effort standpoint of the way to address it, I think you need to view it through eyes of materiality. Now, you also need to recognize your view of materiality may be different from your auditor. So I think it is good to make sure you're confirming with them before you go down a certain route. But I think you probably at this point may know, at least from a volume perspective, if you expect that to be material. So I would consider that. Also, I think look at what will your core or loan system allow you to do. We have noted some issues where because the fee is being paid by the SBA and not by the borrower, that some institutions were having difficulty setting these fees up within their system to defer. So I think you'd look at it of, well, if your core is not going to allow you to do that, then what is the next best course of action? And then also, can you manually track them? And then one point I'd add, also with the materiality concept, we've gotten a lot of questions of, well, in theory, all these loans should be moved off our books within really a 2-month period, maybe longer. And I generally agree. I think at this point that if everything works as planned, for the most part, most of these loans will be off your books by the end of the year. I think there'll probably be some out there. So by that math, you could be saying that it might not materially misstate our year-to-date earnings, which I think that's true. And I think through that lens, if you're looking at just year-end financial statements, I think you could really, that broadens what that materiality looks like. However, I would say still keep in mind, whether you're a public filer or not, you have quarterly reporting requirements, whether those be 10Qs, earnings releases, or call reports. And I think that there will be more sets of eyes on these than just your auditors at year end if you're a private company. So when you're looking and assessing that materiality, I would also be looking and considering how is that going to impact your quarterly reporting leading up to year end. So one thing we did as we were talking and having more discussions with clients on this was, okay, we know people are having issues with core systems. We know based on at least the guidance put out thus far, especially with the advanced covered loan purchase option that the CARES Act provides for, that we think most of these loans could be moved off your books in a chunky manner, thus making it potentially pretty easy to materially track the fee recognition over the life of these loans on a pool basis. So what we did here, not this is probably one of the many ways you could do this manually, but tried to put an example together in a spreadsheet just of how one might consider moving these loans off their books and then recognizing the fee accordingly. So in this case, we assumed $80 million in originated loans. We know based on a number of banks we're talking to, we'll have some well in excess of this. We'll have some well below this, but so it'll be kind of across the board, kind of getting back to the materiality concept. But looking at that and then what the fees are structured as, if you're doing $80 million worth, it looks like you'll probably come in somewhere from a $2 million to $3 million in fees originated. So I think that kind of looking at it through that materiality lens, that's something that needs to be considered. And what we did here was just structure something that would say from a pool basis, as we move loans on these books, what would be an easy method to recognize these over the life, knowing that, like I said, they'll move off in chunks, but I also truly believe not 100% of this will be moved off your books by year end, whether that be through there's some type of put back through the advanced loan covered purchase option if somebody doesn't have the proper forgiveness, or as my example is, this is very cheap money. So you may have very well people applying to this and saying that they're going to use it for payroll, and instead they go out and buy a Bentley with it. So I think there will still be some on your books after year end. So I think it's good to consider what this looks like after you stretch it out. So this is just one of many methods. If you're curious of how to go about tackling this or have questions about what the best way is to account for this on a manual basis, if that's the method that you choose to take, or if you need to figure out from a core system perspective what the best route to take is, please don't hesitate to reach out to us. We're more than happy to have these discussions with you and try to help out and assist as needed. I think the word of caution at this point is, as you can see, the SBA and Treasury are still trying to figure out how to actually get these loans dispersed. I'm not sure they've really had a lot of thought put into the advanced purchase or the forgiveness piece yet. So, like I said, not sure exactly how these things will be moved off your books and whether the Treasury or the Fed's facility looks like to move them off. It's still early there. So at a minimum, this may be not a bad route to take just for you to help model what your financial reporting impact will look like, because I think there will be some big pops to income at different times throughout the year as a result. So with that, just a little bit of additional information to provide to everyone. Just from an Elliott Davis standpoint, if you have not seen this already, we do have a COVID resource center. So this is not only banking related, but a number of our other industries as well. It relates to them. So this is not just a helpful resource center for you, but also could be for your customers as things pop up. So please please go visit us if you have any questions, and if things are not listed on this resource center, please don't hesitate to reach out. Also, our financial services group over the past 2 or 3 weeks have issued a number of different pieces of guidance, whether our larger quarterly update on financial reporting, as well as some modification and TDR guidance that really came out before any of the updating interagency guidance came out. But ultimately, I think that's still a good point of reference if anybody's looking and trying to hone or craft a TDR policy. I think there's some good things that you can use and maybe help you from at least establish significance. Because I think, at least in my mind, I think there's going to be a lot of modifications that are still coming after this period that is defined currently in interagency guidance. So I think there's some good material in there that might allow you to help establish some potential bright lines on significance, which, to be honest, GAP and most regulatory guidance, other than the new ones, don't really do a great job of providing bright lines, or at least black and white. That was our intention of trying to put out that financial services alert. And if anybody on the call did not receive either one of those or would like copies, please don't hesitate to reach out to me and we will get those sent over. So with that, we just want you to, we'd like to thank everybody for sharing the few minutes with us this afternoon, and hopefully you were able to find some of this information beneficial to you and your institution. If there's anything that we haven't addressed or any additional questions that you may have, don't hesitate to reach out to us. As you see, our email addresses and phone numbers are within the bios in the back. In addition, if you did not receive the slide deck, don't hesitate to reach out to me. I know we sent that out in some earlier emails, and it may be actually within a calendar invite on your Outlook calendar. But if you did not receive, feel free to reach out to me, Josh White, and I will send you, get that slide deck over to you this evening or tomorrow morning. So with that, I'd like to thank our presenters for helping us today on the webinar. And then I'd also like to thank Tracy Jones and Jason Nunley for helping to pull all this together. With the time, I think we do have a few questions that have come in, but given the time, what we'll do is compile those answers to those and send those out to the submitters individually. So thank you for sending those in. And if you have any additional questions or comments, like I said, don't hesitate to reach out to us or any of your contacts at LA Davis and our financial services practice. So with that, we'd like to thank you for joining us. Please stay safe, keep social distancing, and I hope you have a great rest of your day.